This is 20 Minutes of Impact from the United States Energy Association Power Sector Podcast, sponsored by Energy Hub. I'm Herman K. Trabish. I've covered the power sector since 2006, and I currently report for Utility Lab. In this episode of the podcast series on virtual power plants, or VPPs, my guest is Ryan Hledik, principal with multinational business consultant, the Brattle Group, and author of extensive research on the various types of load flexibility. Ryan's going to describe how the deployment of VPPs can put downward pressure on rates and how hyperscale data center owners could fund VPPs to accelerate interconnection without putting upward pressure on rates. Ryan, a Stanford engineer by training, began his career in research with Charles River Associates in 2002. After a short time with Stanford's Energy Modeling Forum in 2005, he joined the Brattle Group as an associate in 2006, and after a decade of power sector analysis, became a principal in 2015. Now, a decade later, he's pretty much one of the foremost experts on load flexibility and how it can be used. Ryan, in your landmark 2019 research on load flexibility, you pointed out that traditional demand response was evolving, and you forecast 198 gigawatts of load flexibility by 2030. A lot of people are telling me these days that load flexibility is now evolving into VPPs. Wood Mackenzie found there's 37.5 gigawatts of installed US VPP capacity, and that was in September 2025. There's a lot, probably a lot more now. So let me ask you this. From load flexibility to VPPs, will that 198 gigawatts of load flexibility you mentioned in 2030, is that going to become 198 gigawatts of VPPs? Is it going to be more? Is it going to be less? Why? Why not?
Sure. Yeah, no, happy to answer that. But first, Herman, just want to thank you for having me back on the podcast. I looked back and I think I was your guest for episode 6, and now you're on episode 200 something. So
Yeah,
exciting to see all the progress there, and looking forward to joining you again for episode 400.
not going to
But
wait that long.
going back to your question, I think the important place to start is, what do we mean by VPP?
Yeah,
Is it demand? Does it include demand response? Does it include load flexibility? To me, it's all of those things. And
right.
so by that definition, we have about 50 to 60 gigawatts of that type of capacity on the system today. I wish I could say we were going to hit 200 gigawatts by 2030. I think we can eventually, but when we look back over the last 10 to 15 years, development of this resource has been fairly flat. It's grown at less than 1% a year. I think that
Hmm.
capacity has gotten smarter and it's gotten more valuable, but we haven't seen explosive growth in demand response capacity across the US. The good news here is, if we look back a little further than that, we did see United States demand response capacity double between 2006 and 2011. That was primarily due to some initiatives that FERC introduced to open up wholesale markets to demand response participation. So we've seen that this is a resource that can scale very quickly. And I do think that we could see the current capability doubling or tripling over the next several years. Um, that my 200 gigawatt estimate, that was actually conservative. It didn't include batteries. It didn't include vehicle to grid, didn't include data centers. We weren't even really talking about data center load growth at the time we did the analysis. So I think there is huge potential for this to grow and continue to grow, and grow a lot faster than we've seen in the last decade. We are not currently on the trajectory, though, to hit that level of growth over the next 4 years.
Okay, I want to get a little bit of insight into why or why not. You mentioned the FERC, Federal Energy Regulatory Commission initiative early on. Um, we have Order 2222 that's going to introduce more DER into markets. We have more utilities taking a look at VPP capabilities. Is that not enough, Ryan?
It's definitely creating some tailwinds and some momentum. I think what we've seen over the last couple years is probably the utility gearing up to do more of something that they haven't been scaling very significantly in the past. So we're probably in a situation where there are a couple years of development, and then I would expect to see an inflection point in growth of this resource. The challenge is kind of the two big barriers that we've always had related to demand response and VPPs, they still generally do exist. One is the financial disincentive that regulated investor-owned utilities have to do this versus go out and invest in traditional infrastructure. And the other is just sort of a general lack of trust in the operational capabilities, the performance capabilities of this resource versus just pushing a button and turning on a power plant. Those are still hurdles we'll need to overcome to continue to scale the resource.
Well, that actually brings me to my next question because you've done some work on the idea of system utilization. And what happens is when you have VPPs, that's load flexibility, and it allows using VPP, distributed energy resources to shift some of the use of the power system to off-peak hours. You can shift charging of electric vehicles during the night. You can use batteries to take up the solar on during the midday and use it when demand is greater.
Yep.
That system utilization, you've written that it creates downward rate pressure. Now, I'd like you to explain what that means, what the rate impacts are, and why they go down. And I'd like you to go ahead and explain them in mathematical terms, like the utilities and regulators use, but also explain it in everyday terms, because I'm not sure I remember what a numerator and a denominator are.
Sure. Yeah, no. So I think, as a starting point, the important thing to appreciate is a large portion of the costs that are being recovered through your electricity rate are fixed. It's the poles and the wires and the power plants that your utility has already gone out and invested in, and they're now recovering the cost of those investments through your rates. So if you can spread out those costs or share those costs across more customers, then everyone pays less as a result of that, right? It's the same reason we carpool, right? Like more people using the same resource kind of benefits everyone from a cost standpoint. Um, and we have seen that relationship play out historically. When we did some research that was released last year with Lawrence Berkeley National Lab, we actually saw that the states that had experienced the most load growth were actually the states that had also seen the most significant declines or downward pressure on their electricity rates. So this is definitely something that we've observed. I think the big question or challenge we're facing now is the reason that worked historically is those utilities had spare capacity on their system, headroom on their system to accommodate that new load without having to go out and make big investments. That situation is changing. We've quickly, with data center load growth, we've quickly used up a lot of the spare capacity that existed on the system. So now continuing to accommodate load growth will require some type of action or investment to continue to grow the system. So the question is, is there a way for us to continue to create those conditions we saw in the historical data and serve this new load growth without having to make these very large investments? And that's where VPPs come in. If we can create additional headroom on the system through flexibility and through efficiency, we can continue to bring these large customers into the system, pay for a significant share of the fixed cost of the grid that we already have, and then put downward pressure on rates for other customers as part of that. This won't completely eliminate the need to invest in new infrastructure. We will still need transmission. We will still need new power plants to serve this load, but it can alleviate some of the cost and some of the risk and ultimately create beneficial outcomes for customers as a result.
Okay. Does that mean when you talk about that, are you thinking we used up a lot of capacity? The data center load is using up a lot of the peak load capacity, and that's why there is this need for more transmission, more generation to meet the peak load. And by moving some of this load away from peak, you can avoid having to invest in the new infrastructure. Is that what you're talking about?
That's right. Yeah, it is still the peak times are when the grid is constrained. And so you need to have enough capacity on the system to serve load during that hot day of the summer when everyone's running their air conditioners and you're turning on every last power plant in order to keep the lights on. That's still the same challenge that you have to address as new data centers are being added to the system. So if the data centers themselves or other customers can be shifting their usage outside of those peak hours, you can create some space on the system to continue to accommodate that load growth.
And I've heard that like a lot of times the system is running at 50% of its capacity. So if you could just shift the electric vehicle charging or maybe some of the data center uh, activity to when the system is at 50% of its capacity, it could be a huge change for the better in terms of the costs of adding to the system. Am I getting that right?
Yeah, that's exactly the idea, is shifting, some of the usage out of those high use hours into the lower use hours so that you can improve that dynamic. There are limits on how far you can push this. I mean, a system won't run well if it is being utilized 100% all of the time, because components of the distribution system, for example, need hours with less loads so that they can cool down, and that helps to manage maintenance costs. You also do want to have some spare capacity on your system for reliability purposes, right? So that you are ready for that unusual weather event where there's a heat wave and demand is even higher than you would have expected under more normal conditions. So there are limits on this concept, but I think the general view is that there's still a lot of room to improve in terms of current utilization of the power system.
Here's a quick note from the sponsor of our series of podcasts about virtual power plants, Energy Hub. What if everyday devices had the potential to strengthen the grid when it's needed most? Energy Hub helps utilities turn that potential into dependable capacity by coordinating thermostats, EVs, batteries, and other devices so they work together as virtual power plants or VPPs that respond to grid needs in near real time. Energy Hub's latest white paper lays out a maturity model for VPPs that can be planned and dispatched with the same confidence as conventional plants while being 40 to 60% less expensive to build. That's why more than 160 utilities across North America partner with Energy Hub to manage over 2.5 million devices that provide 3.4 gigawatts of flexible capacity. Read the white paper and discover what BPPs can do for your grid at energyhub.com. Exactly. And that brings me to my next question, the room to improve. Um, there's a question about whether regulators should allow companies that want these big gigawatt scale data centers pay for customers' DER. A Microsoft who wants to get data center could in, increase its ability to get interconnected, its big load data center to get interconnected if it goes out and pays for a whole bunch of customers to have DER, but that includes a requirement that aggregators who are associated with the local utility and Microsoft as well could then use those DER to do just what we talked about, moving some of the load of customers away from the peak when the data center needs to use that peak load. Do you think that regulators should approve that kind of plan, Brian?
Uh, I mean, subject to making, to various considerations that we can talk about, absolutely. I think this is a huge opportunity. I think the term that's been kind of used to refer to this model is a bring your own distributed capacity model. And I mean, the reason I'm so excited about it is this could really be just transformative for the demand side of the industry, the VPP developers that we've just been discussing. If you look at the market capitalization of Google or Microsoft or Amazon or any of the hyperscalers, any of those companies' market capitalization alone is larger than the market cap of all of the US investor-owned utilities combined. So when you think about the resources that they could bring to this issue to scale capability on the demand side, it is massive. Um, and so I do see this, going back to your earlier question, will we get to 200 gigawatts? I think this is one of the reasons that I'm optimistic that we can. Um, and we're currently working on this it is happening. Like, we are working on this with Google right now. They are going out and exploring partnerships with utilities to pay to build out the utilities demand side management portfolio. You probably saw that Google just committed, I think it was $50 million in Minnesota
Yeah.
to deploy distributed batteries across Xcel Energy system. So this is happening. I think there are a couple things that regulators will want to look for to make sure that this is a good deal for everyone, including consumers. One is I think regulators will be looking for incrementality, right? They'll want to see that the data center developers, the hyperscalers, are coming in and paying for new capacity on the demand side that otherwise wouldn't have been developed through the utilities sort of standard demand side management plans.
Mm,
That's one. And then the other one is they'll want to see the hyperscalers paying for the full cost of that new resource that they're developing.
mm,
I think there are no surprises there. I think that makes a lot of sense. My hope is we can we can be satisfied. There's a lot of accounting, there's a lot of math that needs to be done to get convinced that that's the outcome. I'm hoping we can be satisfied with some level of approximation there so that the perfect doesn't become the enemy of the good and we completely pass up this important opportunity that we have right now.
okay. I have a couple follow-ups. I just want to make an observation since you mentioned that Minnesota project. The batteries that project that Google is going to build adds 30 gigawatt, I think 30 gigawatt hours to the system, and the whole U.S. system has something like 57 gigawatt hours up to this point. So it's a huge investment, a huge opportunity there, and it's the kind of thing that we're talking about here. But to get down to my questions, would this plan of the hyperscalers paying for distributed resources, would it address their need for speed to power? Is that their benefit? They get that power, they get on the system faster. And how does it benefit the customers? It's pretty obvious that it would, but explain that for me.
Yeah, no, I think speed to power is the number one reason that I think hyperscalers would be interested in this. We're at a point where you can scale VPPs and demand response much more quickly than you can get a gas turbine, get through the interconnection queue, and then develop that project. They're scaling demand response is maybe a 1 to 5 year activity. Building new conventional generation at this point is, I don't know, maybe a 5 to 10 year activity when you account for all those constraints. So speed to power is absolutely an advantage of this model. Another is for companies like Google. I mean, this also aligns well with corporate decarbonization or sustainability goals. This isn't going out and building a gas plant. This is going out and using less energy or using that energy more intelligently. So it has that benefit as well. Um, I think the other important thing here, it's maybe less of a primary consideration for the hyperscalers, but these are also very cost-effective resources. So not only is it faster and cleaner, it's also cheaper. And that the good news there is, utilities tend to be sort of limited by regulatory cost effectiveness tests when they're going out and deciding how much of this resource to develop. Private third parties that are coming in and paying for this resource, they're not limited by cost effectiveness tests. They can pay whatever it's worth to them to develop this capacity. And so, to your question about what's in it for customers, customers potentially could receive very significant incentive payments if they're willing to let their air conditioner, their smart thermostat be changed by a couple degrees on a few days of the year. Like that could be a meaningful financial reward for customers that would come out of this.
They might also get batteries at the hyperscalers' costs and have them in case of a need for a backup in an emergency, right?
Absolutely. Yeah.
Yeah.
Buying down the cost of technology that the customers otherwise wouldn't be willing to invest in would be a huge benefit of this model.
Okay, one follow-up question left here in my mind, Ryan. Um, a lot of this plan depends on the hyperscalers or the grid operator being able to use these DERs that the hyperscalers are paying for, but they're putting at customers' homes. Is there some way to ensure that the customers will allow them to be used when they are needed so that to protect the system?
Um, yeah, and I mean, I mentioned we have 50 to 60 gigawatts of demand response capability on the system today. It's no different than what we've been doing with those types of programs that we've been relying on to manage the power system for decades. Um, Part of the agreement on the customer's side is if they're going to receive this incentive payment, if they're going to receive a discounted battery, they do need to be willing to allow their utility or their aggregator to control that technology during certain hours of the year. The reason that works out for customers is those contracts will include limits on how often that technology is going to be controlled to make sure that the customer still receives reliable service, that their comfort isn't disrupted, those sorts of considerations.
Yeah, one guest we've had on the podcast here tell me that the aggregators who do that are getting better and better at making sure that customers are not disrupted or uncomfortable anyway. But I want to move to one more question. We have one more question left that I want to get to, Ryan. Our sponsor, Energy Hub, proposed something called the Hewells test recently, and it's caused a lot of conversation in the industry. It's designed to identify how much a virtual power plant's performance matches the performance of a traditional power plant. It's like the Turing test, which was proposed a long time ago by Alan Turing to compare computer intelligence to human intelligence. Do you think that's a useful way to track the growing capabilities of load flexibility, demand response, virtual power plants? Do you think it's a good idea to use this test?
I do. I like it. And the reason I like it is goes back to my answer to one of your questions earlier. One of the biggest barriers that continues to hold back VPPs is system operator concern about the operational reliability of these resources. And so if we have a very clear, somewhat technical and nerdy way of demonstrating that a VPP can give you the same reliability, the same benefits as the conventional resources that you're used to, my hope is that that would go a long way toward overcoming that barrier. I think an important thing to highlight about Energy Hub's Hewells test, at least as I understand it, is I don't think Energy Hub is coming in and saying, unless you pass this test, the value of your resource is zero. They're
Right,
instead defining
absolutely.
this as a standard, and something I really liked that they introduced was a kind of like a technological maturity framework where they said, there
Yeah,
are different levels of maturity, different levels of reliability that these resources have. There's value associated with each of those levels, but it's progressive. And the more you start to look like a very flexible, very dependable resources, the more valuable you are to the system. And that to me is key. We do need to recognize that not every resource is the same. Each resource, whether we're talking about a VPP or a offshore wind farm or rooftop solar or a gas plant, they each have their own advantages and disadvantages. And when we're thinking about the value of those resources, we should be taking those into account rather than saying it's binary and either you look like a gas plant, so you get value, or you don't look like a gas plant, so you don't. I think that's the important distinction here.
yeah, and the Energy Hub is very frank about saying that not a lot of VPPs are up to the highest levels of maturity yet, but that scale is there, so it sets the bar, doesn't it?
Exactly. Yeah, I think they're putting the target out there, kind of defining the gold standard for us to all work toward, and that's something I really like about it.
Okay, one last question. We could talk about it all day, but just get out your crystal ball for just a minute here, Ryan. How much do you think VPPs, load flexibility, demand response, all wrapped into a package with aggregators or a utility, how much can that change the traditional power generation and delivery system? Looking out 2 years, 20 years, 200 years, what do you think?
Yeah, I think that the potential for change is significant. I do think we will always, to a degree, be relying on larger scale, more centralized power generation, just because the economics work well for that type of resource. But I think we're likely to become less reliant on that as we move forward. One of the big reasons for that is, I mentioned earlier that we had done some research with Lawrence Berkeley National Lab last year that looked at the drivers of the significant increases in electricity rates that we've observed recently. The kind of underappreciated big drivers of those rates is all of the investment that's needing to be made in the distribution system,
Right.
both to maintain it and to expand it. And what VPPs and distributed energy resources give you is the potential to defer some of that investment or improve, even if you're not deferring the investment, improve the reliability and the cost effectiveness of that system. And that's not something you get from a large scale transmission connected generator. So I think as more customers adopt these technologies, as system operators become more comfortable relying on them, and we can stack those benefits, that could continue to shift our dependence on these resources in a positive way going forward.
Yeah, I think you're right. Something that LB&L paper that you did and Brattle did with together, one of the things that highlighted is, look, and people don't like to hear this. We're very much underinvested in our distribution
Yep.
systems, especially a lot of these, especially in the East, the earliest places where we built out uh, suburbs and so on. Those systems are old. They need a lot of um, improvement.
Yep.
And by using VPPs, you can spread out the cost of that investment over time so that it's much less of a burden. I completely agree with you on that. Okay, Ryan, we're out of time. Got to go. I want to thank you. My guest has been Brattle Group Principal Ryan Hledik. He's described how far VPPs have come since his early work on load flexibility and how far VPPs can go. I also want to thank our sponsor, Energy Hub, and my producer, Melissa Brown. And of course, I want to thank our listeners for taking the time to check out the USEA Power Sector Podcast. Don't forget to follow, subscribe, like, and share with everybody you know our quest for energy transition solutions.